This is Satya Pradhuman of Cirrus Research. The latest Cirrus Notepad, the title of the report is Capital Budgeting Constraints to Force Allocation of Industrials over Technology Spending. It's a mouthful, but at the heart of it is this trade-off that's always been there between tech spending and industrial spending. And as much as the technology sector is coming under so much pressure because of the rich valuations, interest rates spiking, valuations mattering. All of these things have really worked against the tech sector. But what this is saying is that fundamentally, as we're going through some sort of a slowdown, and we can debate, the degree of that slowdown, the reality is that there's always been a trade-off on the capital budgeting side. And so this chart here is a look at some of the industrial spending normalized for GDP on both bases. So the purple line is tech spending, and that's scaled to the right-hand side, and the blue line scaled to the left is industrial spending. And the heart of it is what we're beginning to observe is that, yes, industrial spending is starting to pick up. A number of reasons we published on this. Part of it has to do with post-pandemic spending. Part of it has to do with really infrastructure spending. Part of it has to do with this Ukraine moment, with the change in the energy infrastructure story. So a lot of these things are coming together potentially under infrastructure. And at the end of the day, though, that if industrial spending accelerates, there's a good chance that tech spending is probably likely to slow. After all, there's only so much money in the till. And if you're going to shift your allocation in CapEx, it's got to be at a trade-off. Some degree of rationing is going to take place. This chart or grid actually represents one of the things we did in the report was to look at a case study. The last, I think, parallel we can draw is this 2003-2008 window. The upper panel here is just the performance of the industrial sector. The blue curve is industrials. The purple curve is technology. And what's important is to recognize that we've started this performance window after the major sell-off in tech. And what happened in the next 6-8 years was the lower level shows that industrial spending started to accelerate as tech spending basically lay flat. The markets caught wind of this, and these stocks took off. So at this point, if we're now starting to see the thin blue line here representing industrial spending, if this truly starts to take off because of everything we're looking at in this environment, then what should correspond is that markets are going to chase industrials more. And so we think this is really the trade that's underway. Empirically, let's look at this. This is a look at the correlation levels between technology and industrial sectors. And what this shows is that they're generally, if you're looking back at this data the last 20 years or so, they've generally been a 0.3 sort of correlation level, a minus 0.3, which says they're generally negatively correlated. Importantly, where we're at today is decade level lows that we're witnessing that goes back to the early 2000s. So in other words, these groups are are generally unrelated right now. They're very uncorrelated. And so if we're right about the fundamental demands of infrastructure and therefore industrial spending, it does seem to us that the demand pattern for technology is likely to soften. Take a look at the report. I would love your feedback as always, and thank you very much.